You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernal. The U.S. and Iran have agreed to end their blockade on the Strait of Hormuz while they negotiate a longer-term agreement. Despite the reopening, insurers and ship operators are skeptical there will be sustainably safe conditions. This perceived risk is boosting insurance premiums for war risk and discouraging a more complete normalization of ship traffic. On today's episode, we talk with Michelle Bockmann, Senior Maritime Intelligence Analyst with Windward, about how the shipping insurance market prices war risk and how insurers view the fragile U.S.-Iran peace agreement. Stay tuned. Coming up soon, our interview with Michelle Bockmann, but first, a quick market update. The U.S. and Iran signed a 14-point memorandum of understanding last week to reopen the Strait of Hormuz for 60 days while they discuss a longer-term agreement. Front-month WTI crude oil is trading below $70 for the first time since early March, and ship traffic has gradually increased. Bloomberg data shows 34 tracked vessels transited the strait earlier this week after months of nearly zero traffic. Before the war, this number was closer to 125 per day. The Fed left rates unchanged last week, as expected, but Kevin Warsh delivered several surprises in his first meeting as chair. The policy statement was more concise, Warsh did not submit estimates for the summary of economic projections, and the press conference was notably more ambiguous than what investors grew accustomed to under the Powell Fed. Warsh also announced the formation of 5 task forces that will research potential reforms relating to the Fed's communications, its balance sheet, the data sources it uses, productivity, and its inflation framework. The meeting was otherwise viewed as more hawkish than expected. 9 of the 18 FOMC participants that submitted dots for the SEP projected rates to be higher by the end of this year, and the statement ended with the blunt statement, "The committee will deliver price stability." Overnight index swaps are now fully pricing in a rate hike at the October meeting, and intermediate treasuries sold off more than 10 basis points on tighter policy expectations. Meanwhile, yields at the long end of the curve were less sensitive to the Fed meeting, and the biggest price action was a rally following President Trump's social media post that said Iran would not be charging tolls in the Strait of Hormuz. Yesterday, the PCE deflator rose 0.45% in May, while the core PCE deflator rose 0.32%. Progress in U.S.-Iran negotiations will allow the Fed to be cautiously optimistic the worst energy price increases are in the past, but most measures of underlying inflation are still too hot outside any future pass-through to the core. That's all for the market update this time. Now our interview with Michelle Bockmann. Our guest today is Michelle Bockmann, Senior Maritime Intelligence Analyst with Windward. Michelle, thanks for coming on the podcast.
Thanks for having me, Will.
Our topic today is shipping insurance in the Strait of Hormuz. Now, to give complete context, we're recording this the day after the U.S. and Iran announced they will sign an agreement on June 19th to reopen the strait for 60 days while they discuss other aspects of a longer-term deal. But back to shipping insurance. First off, Michelle, tell us about these ships that transport oil and all the other important things through the Strait of Hormuz. How many people does it take to operate, and how much does an entire operation cost in terms of the ship itself plus all its cargo?
Okay, so a ship is crewed typically an oil tanker with about 25 seafarers. The vessel itself, depending on its age and condition, would be worth perhaps 80 to 120 million dollars, and the cargo it's carrying would be, especially for a very large crude carry, would be, say, at today's prices, just under $200 million. So a lot of money involved.
These ship operators, what are they usually looking for from their insurance coverage? We all have a decent sense of what we want from our car insurance or health insurance, but what are the sorts of liabilities that are most relevant if you're in charge of a boat that's going through the Persian Gulf with a lot of crude oil?
Okay, so there's 3 types of marine insurance that ship owners have to put in place. The first one is P&I, protection and indemnity coverage, that covers third-party liabilities. Then there's hull and machinery, which, as it says, it covers the vessel's hull and machinery. And then there's cargo insurance. And in addition to that, when you go into a high risk area like the Strait of Hormuz, you have to pay an additional premium via war risk for those insureds. So the additional premium is paid when you go into a listed area. And obviously, the Gulf of Oman, the Persian Gulf, and even the Red Sea area are all listed areas. So you would have to pay the additional premium. That's set as a percentage of your hull value, and that can vary depending on the risk and where things are sitting.
Got it. And so, can you go back to that first step, the P&I? That is just damage to the ship. Is that correct?
That's third-party liability. So that would cover damage for oil spill, bunker spills, crew injury, etc.
And is the structure of these agreements, you talked about the war premiums, but otherwise, the agreements, do they function with premiums, deductibles, co-pays, et cetera, in the same way that we're familiar with a lot of, insurance coverage in the US for autos or health insurance?
In the case of P&I insurance, that's organized by mutual clubs, and so they have their own arrangements. And hull and machinery and cargo insurance is paid for as premiums.
Can you talk a little bit more about those insurance clubs? I don't think many of our listeners are familiar with them. Are they standalone institutions that really just serve the purpose for this type of insurance?
So the market for P&I insurance is dominated by 12 clubs that form the international group, and the international group cover 87% of the global fleet.
I see. And then otherwise, the people who are the insurers of these policies, are they a part of much larger institutions that are typical household names?
The P&I clubs would reinsure their risk with reinsurers typically at the Lloyd's market here in London.
And now, the typical cost for these insurance premiums before the war began at the end of February, which I'll take as the anchor for normalcy, the before times, how much does the cost of insurance factor into the overall operating costs for a ship in its given year?
Well, so additional premiums, as I said, are a percentage of the hull's value. Before the war started, they were being quoted at like 0.1, 0.2% of the hull value. And very quickly, they went up to 1, 2, 3, even reports as much as 5% of a hull's value. That again depended on the ship size and type, and also its geopolitical affiliation. So US and Israeli affiliated vessels obviously had to pay much higher additional premiums if they were stranded in the Persian Gulf.
So the conflict starts February 28th. What happens with the insurance in this market? Do ship owners get to keep their policies with the agreed upon premiums for the next year or so? Do they reprice the next week with this added war risk, or are the policies pulled altogether? What goes on?
What happened is, especially in the case of the war in Iran, is that notices of cancellation were issued, and as a result, the premiums were repriced and reinstated at a higher cost. So there were a lot of headlines saying that war risk was cancelled, that insurance was cancelled, and that had stopped shipping. That wasn't the case. What they did was issue those notices of cancellation, which probably a poorly expressed term, because the insurance wasn't cancelled, it was just reinstated and repriced at a higher rate.
I'm trying to compare this to maybe other insurance that people are more familiar with, because it does feel unusual that you buy insurance for a type of scenario, let's say a war goes on, and then once that adverse scenario happens, you're suddenly only covered if you continue at a much higher price. I mean, what's the point of getting the insurance beforehand if it's just going to be substituted with a different policy once the actual risk manifests?
Well, I guess you can't compare apples with oranges. I'm only familiar with marine insurance, and I don't know how other policies are structured, but that is something that is not unprecedented and very common for marine insurance. And in fact, it happened when Russia invaded Ukraine. Vessels that were at Russian occupied ports in Ukraine that were stranded, there was the same notice of cancellation and the reinstatement at a higher rate. So for marine insurance, that's entirely normal.
Got it. Okay. Yeah, I'm thinking of homeowners insurance where, let's say, the big storm is coming, and then suddenly, just as my house is flooding, they say, "Oh, actually, we're happy to give you flood insurance coverage. You've just got to pay this higher fee." But I understand that they're not an apples to apples comparison.
Well, because you can't move a house into a walrus zone, can you?
No, that's very true. That's very true.
Yeah.
As part of the US effort to limit energy market disruptions the last few months, we've seen US officials say a few times that the US Navy would escort ships through the Strait of Hormuz even while the conflict was ongoing. How did ship operators and insurers view this offer, this promise of US naval escorts? Was it seen as something credible that would make passage safe?
Well, that's not something that I can really answer because I'm not a ship owner, but I will note that there have been times in the conflict when the offer, if there was one made, of a naval escort would probably have placed the vessel in much greater danger of an attack from Iran than not. That's just how the conflict played out.
Yeah, I think what I'm getting at is that there have been all of these declarations that have come with I think the public has viewed a lot of them skeptically about how safe the strait is, how the evolution of the conflict is going. And so when the US announced this, was it seen as something that would guarantee safety? Or were there so many other risks that no matter if you have a US Navy escort, insurance companies still viewed this as pretty dangerous?
Well, it was an unprecedented situation in the Strait of Hormuz, and transits continued, even though the strait was effectively closed. There were maybe about 10, 12% of current levels. And what we saw was that vessels that were willing to transit through the permission-based northern corridor route of Iran were those that were geopolitically affiliated with Iran, and or cargoes were going to India, China, Pakistan, who had diplomatic agreements with them to get their energy commodities through. And in addition to those transits, we also saw through the southern corridor, through Omani waters, limited amounts of tankers go through with their automatic identification signal, their vessel transponder turned off, with guidance and support from the US.
As I mentioned earlier, the US and Iran said they will sign an agreement later this week to reopen the strait for 60 days. And even if for whatever reason that does not come to pass by the time we publish this interview, I imagine there will still be a point in the future that an agreement is reached. So, walk us through how you see insurers and ship operators reacting to this announcement, and how do you think they'll react if the agreement is indeed signed on June 19th? And what I mean by this is you can't just unring the bell. You can't turn the switch back on where suddenly the strait is safe. So, what does that process look like when insurers and ship operators sort of feel out to see if safety is real or if it's still kind of risky?
Well, I think firstly, ship owners won't wait for the agreement to be signed before they'll start transiting. It depends on your risk appetite, who owns the vessel, where it's sailing, and how long the vessel has been stranded, because there have been ships there that have continued to trade. So, first of all, which route will be taken? Will vessels go through Iranian waters, through that northern corridor? Will they go through the southern corridor, through Omani waters? How long will it take for minesweepers to go into the traffic separation scheme, which has been in place since 1968? How will ship owners view threats, if any, are made by Iran? There was a false start back in April 1718 with it, when Iran's foreign minister said the strait was completely open. The next morning, about 50 vessels had lined up and started making their transit. The Iranian Revolutionary Guard Corps said the strait was closed again and attacked two of the vessels, and literally 30 odd vessels turned around mid-transit and went back. So all of those considerations will be going through the minds of ship owners with stranded vessels. Ultimately, it's about making sure that they have confidence in the safety and security guarantees that are provided by Iran and the US as to whether or not they go through immediately or whether they wait and see whether or not there's some stability.
Yeah, that issue of mines, I think, is really particularly interesting because even if both sides, US and Iran say that things are safe, who knows if they accounted for all the mines that they may have planted there. And so I imagine you don't want to be the first ship that tries things out to make sure that it's safe. Now, I also want to throw out the idea of things potentially just reversing back to normal. So this is a 60-day reopening, and it is temporary while the U.S. and Iran sort out other parts of the agreement, specifically nuclear enrichment, sanctioned Iranian assets. So it's possible they won't come to an agreement, and then we'll just go back to the kind of stalemate that we had a few weeks ago. I also think it's possible that the president may just say that everything is inactive from a social media post. So there's this risk that things just boomerang back to what we saw the last few weeks. But if insurance is able to reprice that quickly, does that temporary nature of it not really matter to insurers because they can be quite flexible?
Well, war risk additional premiums are recalculated every 7 to 14 days. So I would imagine as this process goes, that the premiums that are being charged will reflect the perceived risk.
You talked a little bit about how the insurance premiums have changed from before the war to now. At what point do you think most ship operators feel insurance is too expensive to use the Strait of Hormuz? Or in that scenario, could general safety and international sanctions be more of the binding constraint rather than expensive insurance? Because as I see it, you do have all of this supplies trying to go through the Persian Gulf via the Strait of Hormuz, but there's the East-West pipeline in Saudi Arabia. Of course, oil is produced in other parts of the world. So is insurance getting to the point where it is the prohibitive constraint on traffic in the Strait?
Some ship owners have decided that they won't do business in the Middle East Gulf until there's peace. But the insurance costs have to be paid either by the ship owner or the charter, depending on how the agreement is with the charter party. So I don't think it's a question of not paying the insurance. The cost is added on into the transit and everything like that. But yeah, you can't not have a ship insured.
Are there any historical examples like this that we can look to for a sense of the path of the insurance market, what the path the insurance market will take, and how much those costs are passed through to consumers? I know you mentioned this is unprecedented, but surely there has been maybe a time that gives us an idea of when a peace was finally agreed upon, how long it took before there was a return to some sense of normalcy.
I'm afraid I have to disappoint. It really, truly is unprecedented. Even the situation I referred to earlier in Ukraine, when the additional premiums, there was a notice of cancellation. Even then, you have many vessels becoming total constructive losses because they were stuck there beyond 12 months. Again, everything we're dealing with geopolitically at the moment, there's no way we can look back and see how the market handled it before.
Yeah, would you agree that as a starting assumption, even if we don't have a historical analog, it's fair to say that it will really take time before insurance prices and ship operators feel fully confident to resume to that February 2026 world, which maybe we'll never return to. But of course, the safety and stability, that consistency, it's not going to be something that happens overnight or maybe within even a few months.
I think if we've learned anything from this conflict is that things can change just with one Truth Social post. So I think that will always be at the back of mind of anybody who is operating in such an environment at the moment.
Now, is there a way for people to follow the spot prices for this insurance, especially if we think it could be used as a proxy for market implied safety in the Strait of Hormuz? I think crude oil prices have been used as this barometer for the intensity of the war or market optimism, pessimism. Is there something that is available for the public to gauge where that thermometer is going? Or I know you mentioned there are only 12 of these clubs, so is it really a pretty concentrated and privately held market in that sense?
Yeah, a very opaque market, and the premiums and what vessels are charged is controlled between the two people that sign the contract. So that information is not widely published.
Michelle Bockmann, thanks for coming on the podcast.
Thank you, Will.
That was Michelle Bockmann, Senior Maritime Intelligence Analyst with Windward. I think it will be interesting to see how the shipping insurance market evolves over the next few months. No matter what the US and Iran say about safety in the Strait of Hormuz, the back-and-forth conflict has made insurers and ship operators unsure about how long peaceful conditions will last. As attacks continue in the region or government officials make threats and declarations, the perceived risk will factor into war risk premiums that are repriced frequently, which will then be passed on to consumers. This could keep global energy prices elevated compared with the end of February for at least the rest of this year. The June jobs report will be published next Thursday and is expected to show the unemployment rate stayed at 4.3% for the fourth consecutive month. Payrolls growth is expected to slow from 172,000 to a still decent 118,000. The last few months of solid labor market data, especially amid the spike in energy costs, have firmed expectations for the Fed to squarely focus on the inflation side of its dual mandate for the rest of this year. Earlier in the week, the ISM manufacturing for June, JOLTS for May, and ADP private payrolls for June are expected to show solid economic activity with rising input costs and a low churn labor market. Next Wednesday, Kevin Warsh is scheduled to speak on a panel at a forum put on by the European Central Bank. This will be his first appearance outside last week's press conference since becoming chair. What he says, and doesn't say, will give a first clue as to what he considers proper intermeeting Fed communication. The following week, the Fed will release the minutes from its June meeting. Considering Warsh's ambiguous comments at the press conference, the minutes will offer details about what the FOMC discussed, even if certain ideas didn't make the final statement or summary of economic projections. By the end of next week, the Supreme Court is expected to rule on Lisa Cook's challenge against President Trump's efforts to remove her from the Fed's Board of Governors. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.